Most people never notice the warning until it is already too late. It shows up quietly, slips under the surface of everyday life, and appears so subtle that the public ignores it every single time. Yet history is mercilessly clear. When this signal emerges, when this particular shift begins unfolding, a collapse is never far behind. It appeared before the Great Depression, before the end of the Bretton Woods system, before the 1970s inflationary spiral, before the 2008 meltdown, and now it is appearing again. The strange part is that it does not look dangerous on the surface. It looks ordinary, almost harmless. But beneath that thin layer of normalcy is the same structural fracture that doomed every previous economic era. And today, you can see it in a place most people still think is boring and old-fashioned: silver. In the past few days, silver has been whipping so violently that even the world's biggest exchanges have been forced to respond. On the COMEX, the silver price has surged to record territory, briefly trading around the mid-80s per ounce, with reports showing a record intraday push near $84.58. Then the rulebook started changing. The CME Group has been raising margin requirements on silver futures as volatility explodes, the modern version of tightening the bolts on a machine that is shaking itself apart. That is not a conspiracy. It is a pressure response. And pressure responses are exactly what you see right before systems snap. Stay with me. My name is Blackwell. I am not a financial advisor, but I study financial systems through the patterns and cycles history leaves behind, the ones most people notice only when it is far too late. My purpose is simple: to show you what is coming before it becomes unavoidable, and to help you stay financially unbreakable in a world growing more unstable by the day. I do not dramatize the future. I expose its structure. Because once you understand how this system truly works, the uncertainty you feel finally makes sense. These pressures are not personal failures. They are signals of a repeating cycle. If you want to stay ahead of it, subscribe and follow along. And tell me in the comments what you are doing right now to prepare, because the habits you build in calm times decide whether you panic or prosper when the shock arrives. The warning that is flashing again is not a rumor, not a prediction, not a doomsday fantasy. It is a measurable historical precursor that has shown up before nearly every major collapse: the fracture of confidence between paper promises and physical reality. In every debt-based era, leaders try to maintain the story. Central bankers talk about stability. Politicians talk about resilience. Institutions talk about safeguards. But when confidence begins to rot, the first place it leaks is the market that has to deliver something real. That is why precious metals, especially silver, become a stress test. Silver is not just jewelry. It is an industrial metal, a monetary metal, and a trust metal, because it forces the system to answer a brutal question: can the promise be redeemed? And right now, the promise is under strain. The London Bullion Market Association documented that silver's late 2025 move was not a gentle rally. It was meteoric, with the organization reporting a fourth-quarter jump that helped cap a massive annual gain. Meanwhile, major banks and research desks are openly warning that the silver market is prone to extreme price swings because the metal is effectively stuck in the wrong places, with inventories and flows creating bottlenecks that amplify every surge and every drop. That matters because fragmented markets are what you get when trust is thinning. Now look at the wider structure around it. When societies feel stable, they accept paper claims. They accept that a number on a screen equals value. They accept that futures contracts represent metal, that deposits represent purchasing power, that government debt represents safety. But when societies feel unstable, behavior changes before headlines do. People pull back. Businesses hoard liquidity. Banks tighten credit. Governments borrow more just to keep the lights on. And the institutions that are supposed to feel untouchable start looking political. In the United States, even the Federal Reserve has been pulled into open institutional conflict, with major reporting describing a criminal investigation and subpoenas involving Federal Reserve Chair Jerome Powell, and the resulting backlash and anxiety about central bank independence. When a society's money authority is treated like a political battlefield, confidence does not die all at once. It bleeds, slowly, quietly, then suddenly. This is how the early 1930s began, not with one crash day, but with credit tightening, bank fear, and public mistrust. This is how 1971 happened, not with a single announcement, but with years of quiet doubt about whether the United States could honor its monetary promise. This is how the late 1970s inflation spiral formed, not with one price spike, but with households realizing their wages were being eaten alive. This is how 2008 built its fuse, not with one bankruptcy, but with leverage, denial, and the quiet retreat of trust. Here is where it gets crazy. The same mechanics are visible right now across multiple fronts, and silver is acting like an alarm bell. When an exchange raises margins, it is telling you volatility is no longer a side story, it is the story. When physical markets become stressed, dealers change behavior. We have seen major bullion market commentary describing moments where parts of the physical supply chain freeze, where dealers stop buying certain forms of silver, and where refineries face backlogs, not because the world ran out of silver overnight, but because the system cannot smoothly convert demand into deliverable product at the speed fear can move. That is what collapse looks like in its early phase. Friction. Not apocalypse. Friction. The inability of the system to fulfill the public's expectations without strain. And while silver is screaming, the rest of the global machine is humming with the same unstable rhythm. The European Central Bank under Christine Lagarde is navigating a continent facing productivity stress and political fragmentation. The Bank of Japan under Kazuo Ueda is attempting to normalize policy in a world addicted to low rates, a dangerous transition when debt towers are built on cheap money. The International Monetary Fund, led by Kristalina Georgieva, keeps warning about debt vulnerabilities and growth fragility because the global system is now an interlocked web of obligations that assumes calm forever. And at the Bank for International Settlements, the institution that studies systemic risk for central banks, leadership has shifted from Agustin Carstens to Pablo Hernandez de Cos, an era change at the very place that watches the plumbing of global finance. This is not trivia. It is the cast of the present cycle. These institutions are trying to manage a world where debt has outpaced stability, where trust is thinner, and where shocks travel faster than policy can react. Now add energy, because energy is the heartbeat of empires. Venezuela is no longer a footnote in energy markets. It holds the world's largest proven oil reserves, about 300 billion barrels, yet its production remains low and structurally constrained due to decades of underinvestment, crumbling infrastructure, loss of expertise, and sanctions. Production is now below 1 million barrels per day, far short of the over 3.5 million barrels per day the country pumped in the 1990s, exposing deep systemic problems before broader market forces are even considered. What has made Venezuela especially volatile recently is how the United States government has intervened. U.S. President Donald Trump has aggressively pushed to bring Venezuelan oil back into global markets, hosting meetings with major oil executives and promising support for billions in investment to revive the sector. Chevron has signaled it may boost Venezuelan output by around 50% within the next 2 years, contingent on approvals. But major firms like ExxonMobil have publicly called the country uninvestable without legal and commercial reforms, forcing Trump to publicly criticize them and hint at investment exclusions. Because of this uncertainty around Venezuela's supply prospects, oil markets have been highly sensitive to geopolitical headlines. In early January, crude prices climbed to multi-week highs as traders priced in the risk that Venezuelan supply might not materialize quickly enough to offset other global tightening pressures, and unrest in Iran added further geopolitical risk premiums. These dynamics matter because energy costs are a core driver of inflation. When oil prices are volatile or rising, transportation, manufacturing, and food costs tend to follow, making inflation more persistent and harder to dislodge. That persistence can force central banks like the U.S. Federal Reserve to keep interest rates elevated longer to try to control price pressures, slowing growth elsewhere in the economy. Research shows that when markets perceive inflation as entrenched due to supply uncertainties, policymakers are slower to cut rates. Higher interest rates over extended periods increase the cost of servicing debt for governments, corporations, and households. When debt servicing costs begin to outpace economic growth, cracks appear in places once thought stable, feeding into broader financial strain. This is the silent threshold every debt-based empire eventually reaches. The cost of maintaining the illusion of stability becomes greater than the economy's capacity to sustain it. Gradually, lenders charge more for risk, consumers borrow less and spend more on essentials, governments run ever larger deficits just to cover interest payments, and the public's confidence in the currency's purchasing power begins to erode. When confidence fades, the entire system enters an accelerating breakdown, not because of panic, but because arithmetic is merciless. Debt compounds faster than income, and the slightest disruption in energy or credit flows can reverberate through multiple layers of the economy, revealing that the apparent normalcy was always closer to a structural fault line than to stability. Governments roll deficits that would have been unthinkable to prior generations. Households use credit for basics. Corporations refinance at worse terms. Banks become cautious. And slowly, the public begins to behave like the future is less reliable than the past. That behavior shift is the warning, not a single headline, not a single chart, a collective instinct that the story is weakening. Silver matters here because it is where the story meets the shelf. It is where paper meets metal. It is where leverage meets delivery. And when silver becomes a battlefield, it signals a deeper issue. The market is losing confidence in the smooth functioning of the financial machine. Now let us talk about the claim you keep hearing, that silver is going to $400. Could it happen? It is possible over a long enough timeline, in a scenario where inflation, currency debasement, industrial demand, and a repricing of monetary trust converge. There are commentators and forecasts circulating that outline pathways to that kind of number, often tied to multi-year structural deficits and a reset in how silver is valued. But here is the part nobody talks about. The exact number is not the point. The number is bait. The real signal is that people are even entertaining it. When the public starts believing a metal could multiply several times over, what they are really saying is they no longer trust the currency to hold still. In other words, the $400 story is not really about silver. It is about confidence. It is about fear of dilution. It is about the belief that paper claims will eventually be questioned. That is why you must be careful. Not because the warning is false, but because the warning can be misused. Your job is not to gamble on a miracle price. Your job is to read the system's stress signals and build resilience. So let me translate what is happening into the simplest historical language possible. In the late Roman era, the coinage was quietly debased until soldiers demanded more pay and merchants demanded more coins for the same goods. And the public did not call it collapse at first. They called it inconvenience, then corruption, then crisis. In Weimar, Germany, prices did not explode in one day. They rose, then rose faster. Then the public raced the currency because holding it felt like holding melting ice. In 1971, gold convertibility ended because the promise could not survive the pressure. In 2008, the credit system froze because trust vanished between counterparties. In every case, the system failed after the belief failed, and belief always fails first where redemption is tested. Today, redemption is being tested in metals, in energy, and in institutions. That is why you are seeing public debate about the Federal Reserve's independence, and why you are seeing margin hikes and volatile squeezes in silver, and why you are seeing oil markets react to geopolitical tremors. This is not one story. It is one pattern expressing itself through different channels. Now we build fear carefully, without losing control. The risk is not that tomorrow morning the world ends. The risk is that the system continues to grind down purchasing power, continues to normalize emergency policy, continues to stretch debt, and then a catalyst arrives that makes the quiet disbelief visible. A banking event, a sudden recession, a geopolitical shock, a policy mistake, a bond market revolt, a supply disruption, a legitimacy crisis. When confidence is already thin, Catalysts do not need to be large to cause outsized damage. And that is why preparation must be boring, calm, and disciplined. Here are the moves that historically separate survivors from victims, and I want you to comment which one you are focusing on. First, reduce fragility. Fragility is what turns stress into disaster. High-interest consumer debt is not just an inconvenience in unstable times, it is a structural weakness. When rates rise or income becomes uncertain, that debt compounds faster than your ability to respond. Treat it exactly like a leak in a lifeboat, because in a crisis it does not matter how strong the ship looks if water is pouring in faster than you can bail it out. Start by targeting variable rate and high interest balances first, because these are the ones that tighten their grip when conditions worsen. Avoid taking on new lifestyle debt simply to preserve appearances. Stability is not about looking comfortable. It is about remaining flexible when the environment shifts. Second, build liquidity. Liquidity is not about fear or hoarding. It is about control. Cash gives you time, choices, and leverage when others are forced to act under pressure. In downturns, the people with liquidity are not the ones panicking. They are the ones choosing. This does not mean pulling everything out of productive assets. It means maintaining a buffer that allows you to handle job disruption, market volatility, or sudden expenses without selling assets at the worst possible moment. Liquidity transforms uncertainty from a threat into an opportunity. Third, diversify away from single-point failure assets. Modern systems reward efficiency, but efficiency creates fragility. If your entire stability rests on one employer, one industry, one market, one currency, or one institution, a single shock can cascade into total disruption. Diversification is not about chasing returns. It is about reducing dependence. Multiple income streams, varied asset exposure, and geographic or institutional spread all reduce the blast radius of a single failure. Resilience comes from redundancy, not optimization. Fourth, consider a measured allocation to real assets that are not someone else's promise. Real assets are not magic solutions. They are anchors. Productive land, durable tools, critical skills, and physical precious metals held responsibly serve as forms of stored value that do not rely on constant trust in institutions. This is not speculation, and it is not a lottery ticket. It is insurance. The goal is preservation, not excitement. Allocate calmly, store securely, and think in terms of decades, not headlines. Fifth, increase financial literacy. Understanding how central banks transmit policy, how credit cycles expand and contract, how housing reacts to interest rates, and how inflation quietly erodes purchasing power gives you clarity when others feel confused. Financial literacy does not require complex models. It requires understanding cause and effect. When you understand the mechanics, fear loses its grip because you can anticipate pressure instead of reacting to it. Sixth, strengthen your community. Collapses are never purely financial events. They are social stress tests. Families and communities that communicate, share resources, and plan together consistently outperform those that isolate and pretend nothing is wrong. Trust, cooperation, and shared preparation reduce risk in ways no portfolio ever can. In unstable times, social capital becomes as valuable as financial capital. None of this requires panic. It requires honesty. Because the untold truth is that the system you live in is not built for stability. It is built for expansion, and expansion always demands more debt, and more debt always demands more belief. And belief is fading. Silver's violent surge and the exchange response are not the cause of collapse. They are the tremor that tells you pressure is building in the foundations. So here is how you should think about the months ahead. Watch for more signs of institutional stress, not just price moves. Watch for tighter lending and higher delinquencies. Watch for policy conflict around central banks. Watch for supply chain friction in metals and energy. Watch for narratives that shift from soft landing to emergency measures. And watch your own instincts, because if you feel like you are working harder for less, if you feel like normal life costs more just to maintain, if you feel like the future is becoming harder to plan, that is not weakness. That is you detecting the warning humans always detect right before the numbers confess it. When you understand the past, the future stops being frightening, it becomes predictable. And remember, the wise prepare quietly, while the unprepared panic for all to see.